Greetings, fellow traders. This is Richard with Sigmanomics, and in this video we are going to discuss the different types of equities that are available on the various stock exchanges. So the equities market is one of the largest markets in the world. In the US alone, we have over 10,000 equities amongst the different exchanges. Those equities are comprised of common stock, preferred stock, convertible stock, mutual funds, and various types of derivatives. What we'll do now is we'll go through and give a brief overview of each of the different types of equities. So we'll start with common stock. A common stock represents a share of ownership in an underlying corporation. It is the most commonly type of stock that is traded on the exchanges. They are very highly liquid, and most of the high volume transactions that take place in the exchanges are common stock. There are over 5,000 listed on the NYSE and NASDAQ alone. They can be used either for short-term day trading or for long-term investments. And most equity derivatives are based on common stock. So next we'll talk about preferred stocks. So the first thing to know about preferred stocks is that not all corporations issue preferred stock. And those that do so on a limited basis. And preferred stock will always be less than the amount of common stock that a corporation has outstanding. The biggest difference between preferred stocks and common stocks is that preferred stocks pay dividends. And preferred stocks also allow holders of preferred stocks preemptive rights and priorities. For example, if a corporation liquidates, preferred stock shareholders get priorities in terms of payments. Of course, preferred stocks are more expensive than common stocks because they're sold at a premium. And they are typically used for long-term investments as opposed to short-term day trading. Now we'll talk about convertible stocks. So a convertible stock is a type of preferred stock that may be converted to common stock. An option to convert is typically granted after a predetermined date. And when it is exchanged, it's exchanged at a fixed conversion ratio. It may be less than one or more than one, depending on how the issue is structured. And typically, many of the convertible stocks, they'll have a fixed income element whereby a holder of a convertible stock will collect interest payments until such time that the convertible stock is converted to common stocks, and that's when the payments will end. And this is what makes convertible stocks so attractive to long-term investors. And so corporations, when they need to raise some quick capital, they'll create these convertible stocks and use them to achieve their financial objectives of raising capital very quickly. Now we'll talk about mutual funds. So mutual funds are very popular and very widely used. And what a mutual fund is, it's an equity instrument that is composed of various stocks. So it's like a basket of stocks that's selected and managed by investment professionals for a fee. And they can be customized to suit every type of investor. So if an investor is looking for growth stocks, you can find mutual funds that focus on growth stocks. If an investor is looking for an income portfolio, then you can find mutual funds that select primarily preferred stocks that pay dividends. And they're typically used for investments. There's no shorting allowed by mutual funds, so they're not really suitable for trading. And there's a few funds like ETF funds that can be used for trading, but not for mutual funds. By their very nature, are used for long-term and by long-term investors. And lastly, we have equity derivatives. Equity derivatives are also known as equity options. And so we have call options, that's the option to buy, and put options, that's a contract for an option to sell. And these options are the reason that they're used so much by day traders and short-term traders is because they're highly leveraged, and that makes them very suitable. Because what you do is you don't pay for the underlying stock; you pay for the premium for the contract to either buy or sell, and so that's why they're so widely used by day traders. There are what's called leaps, and those are long-term equity anticipation securities, and those are long-term options that are used for managing risk. That's it for the different types of equities. In the next video, we'll talk about the pros and cons of trading and investing in the equities market.